China is a big deal. It's a very big deal. The Chinese embrace of Western-style capitalism has been astounding. It's unleashed a fire-breathing dragon hell-bent on growth at almost any cost. The explosion of modernist industrialism in China absorbed most of the world's commodities. It took massive amounts of capital, which came from debt financing, and produced huge quantities of exports, internal riches, and uplifted an entire society, a nation of 1 billion-plus people, in less than a generation. In fact, in less than 20 years. It's been China's growth that moved the needles all over the globe. Chinese growth enveloped all the emerging markets and Europe. It's been a phenomenon globally and for U.S. investors too. All that growth takes capital, and since China's equity markets are not even adolescent, growth had to be financed by debt. China's debt, public and private, has exploded like nothing the world has ever seen. Total public, private sector, and household debt now exceeds $25 trillion. All that debt, accumulated so quickly, is starting to weigh big time on China. The recent rise in Chinese stock markets was mainly engineered by the government. Why? Because by drawing attention to China's rising stock market and cheerleading it higher, which meant investors believed the government wouldn't let stocks ever collapse, the central planners in the government figured corporations, including all the big state-owned corporations and the banks with their massive debt loads on their balance sheets, would be able to monetize some of that debt by turning it into equity shares, which they would then sell to private investors and magically deleverage themselves. So much for that plan. It failed because in order to get so many new investors to buy stocks, they had to provide them with margin, loan money used to buy stocks. In other words, they planned on creating temporary debt financing facilities for investors to use to buy stocks. That, theoretically, would go higher and entice more and more investors into the rising markets. In the end, it was a quick kick in the pants. All the new margin lending killed the stock market it was supposed to elevate. From January through mid-April this year, new Chinese investors were opening up an average of 700,000 brokerage accounts a month, and they all got margin money to speculate with. Margin lending rose 450% in the same January to April timeframe. All the new investors really had no idea how margin worked against them if stocks were going to fall. They expected the government to prevent the markets from ever falling. That's what they were led to believe. Then stocks fell out of bed, and millions of investors got margin calls. It was a bloodbath. The impact of margin lending to buy stocks in China created an almost instant bubble. The Shanghai Composite rose about 150% in less than a year. The middle market Shenzhen rose more. And when stocks crashed 30% in a couple of weeks beginning in mid-June, $4 trillion was wiped out. Now, markets have rebounded somewhat because of more government intervention, but the psychological damage has been done. There aren't going to be millions of new stock investors running into the markets to help corporations bloated with debt offload those burdens to stock investors. The corporations that joined the game and were using their capital to speculate in stocks instead of manufacturing goods into the economy, which has been slowing for some time, they're out there money too. The economic consequences of the stock crash will wend their way through the Chinese economy. As China goes, so goes the globe. That includes the United States. We will be affected by slowing growth in China. The markets where we export are being affected by slowing China, including, for example, the emerging markets. If they slow significantly at the same time the United States raises interest rates, we'll see an exodus of investment capital out of the emerging markets. That will upend exchange rates, further strengthening the dollar. And a stronger dollar means U.S. corporations earning revenues overseas will be negatively impacted when they translate those foreign currency earnings back into a more expensive dollar. It impacts earnings here. That's only one impact a slowing China will have. We're all connected in the global economy. If China sneezes, the world can catch a cold. Investors need to watch what's going on with China's stock markets. The Shanghai Composite is the principal market to watch. It's trading just under 4,000. The government needs to get it above 4,000 and stabilize it there to mitigate the damage that's already been done. If the Shanghai breaks down again, U.S. investors better know what's happening. They better watch it like they do the Dow Jones Industrial Average or the S&P 500. If it really crashes, say below 3,000, listen to me now or hear me later. U.S. stocks will drop 10 to 20% in about a New York minute.